All right, so Chapter 5, here we're going to deal with intra-entity asset transactions. And the main one we want to concentrate on is those sales of inventory, because by far they're the most prevalent types of transactions that occur between related entities. And so first thing we want to do is understand why these asset transfers create accounting effects within the records that must be eliminated or adjusted in preparing our consolidated financial statements. And so again, think of this as these companies as one unit, even though they have separate accounting records. Remember, both companies continue to exist and have separate record keeping. And so inventory sales between the companies are recorded, and of course the seller is going to recognize sales revenue while the buyer is going to recognize a purchase into its accounts. And so for internal reporting purposes, recording an inventory transfer as a sale or purchase provides much needed data that helps measure the operational efficiency of each enterprise, each company, both buyer and seller. And of course this upstream, going from the sub to the parent, could be downstream, coming from the parent to the sub. So either way. But even though we record a sale or a purchase, depending on whether you're a seller or a buyer, from a consolidated perspective, neither a sale nor a purchase has occurred because, again, we're one entity for consolidation purposes. And so an intra-entity transfer is merely the internal movement of inventory that creates no change in the financial position of the overall consolidated whole. In the consolidated financial statements, we have to transfer these, well, we have to eliminate these transfers, excuse me. And so we only want to show in our consolidated financial statements the financial effects of outside transactions, not inside transactions. And so we do this in our worksheets just like we have with these other previous transactions we've dealt with. And so first thing we need to do is eliminate our sales. And so in order to do that, we have this entry TI, which stands for transferred inventory. And so remember that both parties record the transfer in their internal records as a normal sale and purchase. But on our consolidation worksheet, we're going to have to remove these balances. And so in order to do so, this entry TI reduces sales by the amount of intra-entity sales. In this case, sales are 80,000, which is kind of small, but let's just go with it. From one company to the other, parent to sub, sub or parent, doesn't matter. You still have to do the same deal. And so the sale, which would normally be a credit, right, is going to be reduced. The sales account is going to be reduced by the amount of intra-entity sales, which are $80,000 for the year, and so they debit sales to reduce it. And for the purchases, what they're going to do is reduce cost of goods sold, because normally by this time, purchases account is a temporary account that's been eliminated and transferred to cost of goods sold. And so by reducing reducing the expense cost of goods sold, you are eliminating the effect of those purchases. And again, you've got to do this transaction regardless of whether it's an upstream purchase or a downstream purchase. Now, what's missing still? Well, we still have stuff sitting in inventory of the buyer. And that stuff is sitting in, using their example here of 80,000, let's say it's all still in at the end of the period. They haven't sold to any outsiders yet. What's still left after this entry is the inventory, and it's in the ending inventory of the buyer at this jacked up price. In other words, we haven't really looked at it, but we will here in a minute. In this example, this was purchased at an amount of, I believe, $50,000. Okay, so there was a $30,000 markup, gross profit, on this sale, and so that $30,000 is still sitting in ending inventory. And so, despite this TI entry, the inflated ending inventory figure causes cost of goods sold to be too low and profits to be too high. And so for consolidation purposes, the expense is increased by this amount through a worksheet adjustment that properly removes the unrealized gross profit from consolidated net income. And so you're going to debit or increase cost of goods sold by the $30,000, the amount of gross profit in this transaction, and you're going to reduce inventory by crediting inventory $30,000. And so this example is if all of the transferred inventory is retained by the business combination at the end of the year. What normally happens is they sell a part of a transaction to outside parties, and you're left with only a part of the intra-entity transaction. And so this next example is that instance. And so in this case, we have 20,000 of that $80,000 purchase in ending inventory. And our gross profit rate in the original transaction is 30,000 of the 80,000, and so that is determined to be a 37.5% gross profit rate. And so what you want to do is take and multiply that 37.5% times the ending inventory that remains from our intra-entity sales, in this case 20,000. And so in this case, what you have sitting in ending inventory is a gross profit amount, not of the total sale, because part of it's 3/4 of it's been sold to third party. And only 20,000 remains in ending inventory. But that I guess I shouldn't say it that way. The gross profit sits in ending inventory for that $20,000 balance. And so we don't reverse by 30,000, we reverse it by 20,000 times 37.5. And so our entry in this case is going to be same accounts, cost of goods sold, 7,500 debit, and inventory 7,500 credit. Okay, so that's what you're going to do at the end of year one. Well, what about year two? What happens then? Well, remember that these companies have their own books, and this ending inventory still sits on their books as beginning inventory for the next year. So you've got to make one more entry to correct year two, which it's assumed that that's the year that we're going to recognize the rest of this sale and the profit from the sale, because it's going to be sold to a third party. And so here's our entry G, and this next one is what you have to do to adjust the beginning records for year two, the year in which we're going to recognize this remaining $7,500 gross profit. And so in year two, the overstatement's removed within the consolidation process, but this time from the beginning inventory balance, which appears in the financial statement only as a positive component of cost of goods sold. Remember that, when you're calculating cost of goods sold, you start with beginning inventory plus purchases, right? Equals cost of goods available for sale less ending inventory equals cost of goods sold. Well, if you reduce your beginning inventory, you're going to reduce cost of goods sold, right? So instead of reducing beginning inventory, we're reducing cost of goods sold instead. But it has the same effect, right? It increases income for the period, gross profit for the period, the period in which you're earning this $7,500. So that's that entry, the credit of cost of goods sold. Now, why are we debiting retained earnings? Well, the reason why we're debiting retained earnings is that this reduction removes the unrealized gross profit so that the profits reported in the period when it's earned trying to read here. And so what you're trying to do is it's still in the retained earnings of the books at the beginning of the year. because it's a carryover from the year end, year one, right? And so you're having to reduce retained earnings by $7,500 at the beginning of the balance so that the $7,500 can be earned in year two and will reflect in the ending retained earnings of the company. So that's why you have to reduce retained earnings at the very beginning of the year too. So that's what you're doing there. Now, what do you do when you have this type of transfer, but it is a downstream sale with a parent who uses the equity method? Well, it's a different entry, at least from the standpoint of the debit portion. And so in this case, when the transfer of inventory is downstream and the parent uses the equity method, which is mostly what we've been using in prior examples and problems, the following entry is used to recognize the remaining unrealized profit left at the end of the previous year. And so your debit is going to be to investment in subsidiary. And so I think they point out that they use the investment in subsidiary account because the subs retained earnings has already been closed out or something like that. But anyway, I won't bore you with the details of why, but anytime you have a downstream sale and the parent uses the equity method, just know that you've got a debit investment in subsidiary, not retained earnings. Okay, and so that will be, see if we have anything else. All right, so this just kind of explains the whole downstream transfer thing. And this just kind of continues on with that discussion. So, you know, if you don't really care about the why of why downstream sales of a parent using the equity method, why they use investment in subsidiary instead of retained earnings, just know that you have to debit retained earnings when it's a downstream transfer, and you, the parent, use the equity method. Okay, so tomorrow I will finish up with unrealized gross profit and talk about the effect on the non-controlling interest. We'll look at both the downstream inventory transfers as well as upstream inventory transfers and discuss those.